We will discuss fixed deposits versus arbitrage fund. Are fixed deposits unfavorable for the higher taxpayers? Some people invest in FDs as a source of savings to get consistent returns. But are they really favorable compared to other investment opportunities? Now let's discuss an alternative, arbitrage funds. There are many fund houses, which give opportunities to invest in arbitrage fund. An arbitrage fund is a type of mutual fund managed by fund managers, who help to earn profits by exploiting price differences for the same asset in different markets, primarily by simultaneously buying a stock in the cash market and selling it in the future market. These funds are considered equity-oriented hybrid funds, and their strategy aims for lower risk, more stable returns by risk-free trades, not by taking a directional view on market trends. Benefits of investing in arbitrage funds. Arbitrage funds can offer better returns than FDs, especially for those in higher tax brackets and seeking short-term, moderately low-risk investments. However, FDs provide a guaranteed return and are generally considered safer. Arbitrage funds vs. fixed deposit, FD, potential for higher returns. They aim to profit from price differences between cash and futures markets, potentially yielding higher returns than FDs, especially during periods of market volatility. Arbitrage funds buy at lower prices and sell in the future market. Example: buying 5,000 shares of a company XYZ at 500 rupees today and selling in futures market at 505 rupees per, thereby selling at a gain of 5 rupees * 5,000 equals 25,000 rupees per. This sale of shares is in the near short term within the mutual fund. Liquidity. They offer good liquidity, allowing for relatively quick redemption of funds, but withdrawals take 2 days. Although FD has more liquidity, the earning reduces if you withdraw before the FD matures. Now imagine you have created a FD for 1 year. The rate of interest is 6%. Now if you want to break the FD in 30 days, then you will get interest which will be 3% less the penalty for premature withdrawal. For understanding this, refer this table. Here is the FD rates chart, which can check with your bank for the latest prevailing rates. Arbitrage funds can be withdrawn anytime but will give you better returns. Refer this link to know annualized returns for various funds. Let's discuss tax efficiency, market-linked risk, exit load, suitability, tax efficient. Short-term investments are taxed at rate of 20% and long-term investments, over a year, in arbitrage funds are taxed at a rate of 12.5% compared to FDs, where interest income is taxed at the investor's income tax bracket. So higher income earners pay nearly 40% as tax. The beauty here is that you are taxed on capital gains and not on interest. In FD investments, whether you break the FD or not, interest is calculated quarterly and the interest is taxable, whereas capital gains arise only on sale of the arbitrage fund. Also, 125,000 rupees per capital gain is tax exempted for long-term investments. Market-linked risk. Arbitrage funds are subject to market fluctuations, meaning returns are not guaranteed and can vary based on market conditions. The interest rate on an FD is fixed and guaranteed for the duration of the deposit, making them a stable investment option. FD returns are typically lower than those of arbitrage funds, but they offer capital preservation and predictable returns. Exit load. Arbitrage funds have a lock-in period of 7 days, 15 days, 30 days, after which you can exit without exit load. This gives the investor to stay invested or exit based on need. The investor should preferably stay invested for the minimum period to avoid exit load. Not suitable for long-term. While arbitrage funds can be good for short to medium-term investments, they are not ideal for long-term financial goals where consistent, predictable returns are uncertain as they are linked to the stock market. FDs are well suited for long-term financial goals where capital preservation and predictable returns are prioritized. Conclusion: if you prioritize higher returns and are comfortable with some market risk, arbitrage funds may be a better option, especially if you are in a higher tax bracket and your investment horizon is short to medium term. If you prioritize capital preservation, guaranteed returns, and have a long-term investment horizon, FDs may be a more suitable choice. Thanks for watching, and please don't forget to subscribe to my channel. Thank you.